Hello, and thank you for joining us today. My name is Tim Benningfield with the Small Business Self-Employed Division within the IRS. We hope you will find this presentation both helpful and informative. A few quick words before we begin. I'd like to extend a welcome to any participants from the news media. If you are with the media, please send us an email message at sbsc.webinars@irs.gov with your contact information. Our media relations staff can assist in clarifying the discussion or answering any questions you might have following the presentation. For your convenience, we have provided you with a PDF file of this presentation to download, print, and take notes on. If you did not notice it previously, you will see a link to download the file on this webinar page. You can ask questions during this webinar by clicking the Ask a Question link under the PowerPoint window and selecting the Submit button. At the end of this presentation, subject matter experts will respond to your questions. We will answer as many questions as time allows and ask that you limit your questions to the topics covered in the webinar today. Please do not ask questions about specific case-related situations. We simply cannot provide guidance for individual situations in this forum. Also, please avoid inappropriately disclosing any sensitive or identifying information about you or your business or anyone else when you submit a question. And finally, I would like to remind our audience that the information contained in this presentation is current as the date we filmed the webinar and that it should not be considered official guidance. This program will be archived on our website at www.irsvideos.gov for later viewing in case you want to review what we cover or recommend this program to others. Now let's get started. Are you tired of being a backseat driver when it comes to taxes for your small business? It does not have to be that way. You can grab the steering wheel as you take control and learn tips on how to keep your small business out of tax trouble. Two of the major pitfalls for small business are poor record keeping and a failure to recognize all items that constitute gross receipts, otherwise known as taxable business income. We will also show several best practices that small business should use to avoid tax problems. They are good record keeping, reporting all taxable income, separating business and personal expenses, making sure your returns are accurate, using e-file to increase filing accuracy and speed, choosing your preparer carefully, and finding out where you can go for IRS help. That's a lot to cover, so let's begin. The information being presented today can be found on the Starting a Business page on irs.gov. We will go over some of the important issues that new business owners need to know. These issues include, is it a business or a hobby? Selecting a business structure, employer identification number, understanding business taxes, and record-keeping requirements. All new businesses need to consider this threshold issue. What is a business for tax purposes? Generally, an activity qualifies as a business if it is carried on with the reasonable expectation of earning a profit. In order to make this determination, taxpayers should consider the following factors. Does the time and effort put into the activity indicate an intention to make a profit? Does the taxpayer depend on income from the activity? If there are losses, are they due to circumstances beyond the taxpayer's control, or do they occur in the startup phase of the business? Has the taxpayer changed methods of operation to improve profitability? Does the taxpayer or his/her advisors have the knowledge needed to carry on the activity as a successful business? Has the taxpayer made a profit in similar activities in the past? Does the activity make a profit in some years? Can the taxpayer expect to make a profit in the future from the appreciation of assets used in the activity? The IRS presumes that an activity is carried on for profit if it makes a profit during at least 3 of the last 5 tax years, including the current tax year. It is important that you choose the right kind of business structure for your venture. The most common ones are, first, sole proprietorship. A sole proprietor is someone who owns an unincorporated business by himself or herself. However, if you are the sole member of a domestic limited liability company, that's LLC, you are not a sole proprietor if you elect to treat the LLC as a corporation. Next is partnership. A partnership is the relationship existing between two or more persons who join to carry on a trade or business. Each person contributes money, property, labor, or skill, and expects to share in the profits and losses of the business. A partnership must file an annual information return to report the income, deductions, gains, losses, etc. from its operations, but it does not pay income tax. Instead, it passes through any profits or losses to its partners. Each partner includes his or her share of the partnership income or loss on his or her tax return. Partners are not employees and should not be issued a Form W-2. The partnership must furnish copies of Schedule K-1, Form 1065, to the partners by the date Form 1065 is required to be filed, including extensions. Your business can also be a C corporation. The profit of a corporation is taxed to the corporation when earned, and then is taxed to the shareholders when distributed as dividends. This creates a double tax. The corporation does not get a tax deduction when it distributes dividends to shareholders. Shareholders cannot deduct any loss of the corporation. Generally, businesses need employer identification number, also known as a federal tax identification number. It is used to identify a business entity. You may apply for an EIN in various ways, including online at irs.gov. The qualifying criteria for whether you need an EIN are listed on the website. The irs.gov pages providing information on business structure also gives information on the federal taxes that must be paid and the forms which must be filed with the IRS. The taxes your business may be subject to are income tax. All businesses except partnership must file an annual income tax return. Partnerships file an information return. The form you use depends on how your business is organized, as we discussed in the business structure section earlier. Estimated tax. Generally, you must pay taxes on income, including self-employment tax, by making regular payments of estimated tax during the year. Self-employment tax. Self-employment tax, or SE tax, is a Social Security and Medicare tax primarily for individuals who work for themselves. Your payments of SE tax contribute to your coverage under the Social Security system. Social Security coverage provides you with retirement benefits, disability benefits, survivor benefits, and hospital insurance, Medicare, benefits. Employment taxes. When you have employees, you as the employer have certain employment tax responsibilities that you must pay and forms you must file. Employment taxes include the following: Social Security, Medicare taxes, federal income tax withholding, and federal unemployment or FUTA tax. Excise tax. This section describes the excise taxes you have to pay and the forms you have to file if you do any of the following: manufacture or sell certain products, operate certain kinds of businesses, use various kinds of equipment, facilities, or products, receive payment for certain services. More on employment taxes. If you have employees working for you, you will be responsible to withhold and deposit federal income taxes, Social Security taxes, and Medicare taxes. The funds that you withhold from your employees' wages are referred to as trust funds, since you are holding these monies in trust until you, the employer, deposit these monies into the federal deposit system. As an employer, you will also be responsible to report and deposit federal unemployment tax, known as FUTA. As a business owner, it is important that you understand an employer's responsibility of withholding, reporting timely, and adequately depositing all employment taxes. One of the employment taxes to withhold from your employee's wages is income taxes. To figure how much to withhold from each wage payment, use the Employee's Form W-4, Employee's Withholding Allowance Certificate, and methods described in Publication 15, Employer's Tax Guide and Publication 15-A, Employer's Supplemental Tax Guide. Other employment taxes to withhold are the Social Security and Medicare taxes that pay for benefits that workers and families receive under the Federal Insurance Contributions Act, known as FICA. The total Social Security is 12.4% of wages, with the employer paying 6.2% and the other 6.2% being withheld from the employee's wages up to the Social Security wage base. The total Medicare tax is 2.9% of the wages, with the employer paying 1.45% and the remaining 1.45% withheld from the employee's wages. There is no wage-based limit for Medicare tax, so all covered wages are subject to Medicare tax. Small business employers often outsource some of their payroll and related tax duties to third-party payroll service providers. These services effectively streamline business operations. However, an employer's use of a PSP does not relieve the employer from its responsibility of ensuring that all its federal employment tax duties are met. A PSP assumes no liability for their employer/client's employment tax withholding, reporting, payment, and/or filing duties. A payroll service provider typically prepares employment tax returns for signature by its employer/clients and processes the withholding, deposit, and payment of the associated employment taxes for its common law employers/clients. Now let's turn to one of the most important factors in your small business success: keeping and maintaining good records. Record keeping can help you in several ways. First, you need good records to monitor the progress of your business. Records can show whether your business is improving, which items are selling, or what changes you need to make. You also need good records to prepare accurate financial statements. These include any income statements which show the income and expenses of the business for a given period of time, and a balance sheet which shows the assets, liabilities, and your equity in the business on a given date. These statements can help you in your dealings with your bank or your creditors and in managing your business. You will receive money or property from many sources. Your records can identify the source of your receipts. You need this information to separate business and non-business receipts and taxable from non-taxable income. Record keeping will also help you keep track of deductible expenses. You may forget expenses when you prepare your tax returns unless you record them when they occur. Of course, you need good records to prepare your tax returns. Generally, these are the same records you use and monitor your business and prepare your financial statements. Finally, you must keep your business records available at all times for inspection by the IRS. If the IRS examines any of your tax returns, you may be asked to support the items reported. A complete set of records will help you explain the items you claim and speed up the examination. The next slide shows an example of what a record-keeping system might look like for a small business. Whether you use a system like this or an alternative system, you need to be aware of burden of proof. Burden of proof is the responsibility to prove entries, deductions, and statements made on your tax returns. You must be able to prove certain elements of expenses to deduct them. Generally, taxpayers meet their burden of proof by having the information and receipts or sufficient evidence for the expenses. This substantiation includes receipts, canceled checks, and bills. Additional evidence is required for travel, entertainment, gifts, and auto expenses. The system you use to record business transactions will be more effective if you follow good record-keeping practices. For example, record expenses when they occur and identify the source of recorded receipts. Generally, it is best to record transactions on a daily basis. For more information on record keeping and other small business topics, go to irs.gov and enter Operating a Business in the search box. As you can see, several major topics of interest are listed there. Clicking on these will link to further information, including forms, FAQs, and other resources to help you. One way to keep good records is to open a dedicated business bank account. You should keep your business account separate from your personal bank account. The business checkbook is your basic source of information for recording your business expenses. You should deposit all daily receipts in your business checking account. Consider using a checkbook that allows enough space to identify the source of the deposit as business income, personal funds, or loans. You should also note on the deposit slip the source of the deposit and keep copies of all slips. You should make all payments by check to document business expenses. Write checks payable to yourself only when making withdrawals from your business for personal use. Avoid writing checks payable to cash. If you must write a check for cash to pay a business expense, include the receipt for the cash payment in your records. If you cannot get a receipt for a cash payment, you should make an adequate explanation in your records at the time of payment. Use the business account for business purposes only. Indicate the source of deposits and the type of expense in the checkbook. Gross receipts are the income you receive from your business. Good record keeping also depends on you keeping supporting documents that show the amounts and sources of your receipts, such as cash register tapes, bank deposit slips, receipt books, invoices, credit card charge slips, and Forms 1099 miscellaneous. Once your records are in place, make sure you report all of your taxable income to avoid tax trouble. Filing a tax return and reporting taxable income is more than just checking a few boxes and signing your name to a form. This may seem obvious, but you must report all taxable income on your tax return. Do you know what types of income are considered taxable to avoid tax trouble? All income is taxable, unless the law specifically excludes it. Income from your business can include many forms, such as cash, checks, or credit card payments, or the exchange of property or services called bartering. Bartering is the exchange of one product or service for another, including through the internet. Both parties must include the fair market value of goods or services received as income on their tax return. With bartering, you must include the value of the non-cash income from the exchange as income. To support your expenses associated with your purchases, such as the cost of all raw materials or parts purchased for manufacture into finished products, you need to keep a record that shows the amount you paid for these purchases. Proper documentation includes canceled checks, cash register tape receipts, credit card sales slips, invoices. You also need to verify expenses, the cost you incur other than purchases to carry on your business. Your supporting documents should show the amount paid and the business purpose, such as canceled checks, cash register tapes, account statements, credit card sales slips, invoices, petty cash slips for small cash payments. The area of claiming expenses is a potential pitfall for tax trouble, specifically claiming personal expenses as business expenses. If you keep your business and personal records separate, you will go a long way to avoid this common mistake. While there are many examples we could go over, let's look at 3 top expenses that are looked at very carefully by the IRS. First, home office deduction. Many taxpayers work at home these days. If you have a home office, personal expenses are never allowed as a business expense. Business expenses must be kept separate, and good record keeping is a must when you have a home office. Next is frequent business vehicle use. Just as it's easy to mix personal with business use in a home office, business vehicles are also ripe for unqualified deductions. This doesn't mean you can't claim a business vehicle, but make sure you have a detailed log with the date, destination, and mileage for each trip. And then you don't include stop-offs for coffee or dry cleaning. And finally, travel and entertainment expenses. If you're self-employed, it's tempting to claim lots of meals and travel on the Schedule C you file with your tax return. But you can avoid tax trouble by claiming only the proper expenses allowed by the law. Let's look at the last business expense a bit closer. If you deduct travel, entertainment, gift, or transportation expenses, you must be able to prove certain elements of expenses. If you're claiming business-related trips and entertainment, it's crucial to keep detailed records and receipts of who is there and event specifics. You will be able to deduct the cost of the vehicle you use for business purposes using either a standard per mileage rate or the actual expense you incur. For additional information on how to prove certain business expenses, refer to Publication 463. In addition to allowing deductions which reduce the amount of taxable income, the Internal Revenue Code provides for business tax credits which can reduce the amount of tax on a dollar-for-dollar basis. You can search irs.gov and enter business tax credits in the search box to find out more information. When it comes to preparing the tax return for your business, you may want to choose a professional to help you. Here are some tips. Go to the directory of Federal Tax Return Preparers on irs.gov to start your search on the preparer's qualifications. Avoid businesses which delegate the work to someone with less experience or knowledge. Also ask questions and get references from clients, friends, or coworkers who have used the tax professional before. Find out if they were satisfied with the services received. Select a preparer who will be available to assist you in the future in case you receive a correspondence from the IRS or your return is selected for audit. Check if your preparer is affiliated with a professional organization and if that organization provides or requires their members to obtain continuing education and adhere to a code of ethics. Keep in mind that an unenrolled preparer may be affiliated with a professional organization. Check if the preparer has a mandatory IRS-issued identification number called a P10. Find out your preparer's history with the Better Business Bureau and State Agency for Certified Public Accountants and the State's Attorney General's Office. Other tips are to avoid preparers who guarantee they can obtain a larger refund than other preparers. Beware of a preparer who guarantees results or whose basis for fees on a percentage of the amount of the refund, and remember, a practitioner may not charge a contingent fee, percentage of your refund, for preparing an original tax return. The law requires a paid preparer to sign the return and complete the information in the space provided for paid preparers. In addition, the preparer is required to give you a copy of the return and keep a copy of the return or list with your name and SSN for 3 years. It does not matter who prepares the return. The taxpayer is ultimately responsible for the information reported on the return and, if not accurate, would pay any additional taxes and interest and may be subject to penalties. So double-check every single line before submitting a return, especially if you're a do-it-yourselfer. Be sure all your income is reported, including income for which you did not receive any statements, such as interest income and cash payments. Also, never sign a blank return or sign it in pencil. Watch for common mistakes such as incorrect or missing Social Security numbers, incorrect tax entered based on taxable income and filing status, computation errors in figuring the taxable income, withholding and estimated tax payment, and credits you claim. Withholding and estimated tax payments are entered on the wrong line, and math errors. Most electronic software programs will help you avoid this. It is important that you review your entire return because any errors may delay the processing of your return. Make sure you understand everything and are comfortable with the accuracy of the return before you sign it. Speaking of that, don't forget to sign the return. Believe it or not, that's another very common mistake. When you are ready to file your return, consider IRS e-file, which will help you cut back on math errors that may cause you tax trouble. Best of all, you'll get your refund faster with direct deposit. If you owe tax, you can file early and delay paying with several e-pay options, including credit cards. If you are paying someone to prepare to file your return, make sure they offer IRS e-file. Any paid preparer who prepares and files more than 10 returns for clients must file the returns electronically unless the client opts to file a paper return. IRS has safely and securely processed more than 1 billion individual tax returns since the debut of electronic filing in 1990. For making your tax payments, use the Electronic Federal Tax Payment System. EFTPS is the secure, accurate, easy-to-use way to make federal tax payments of any kind and provides an immediate confirmation for each transaction. The service is offered free of charge and enables employers to make and verify federal tax payments 24 hours a day, 7 days a week, through the internet or by phone. For more information, employers can individually enroll online at EFTPS.gov or call EFTPS customer service at 800-555-4477 for an enrollment form. Staying knowledgeable about taxes is a vital part of your business and one way to avoid tax trouble. IRS has many ways to help you. Check out our website at irs.gov. It has a comprehensive list of helpful publications and other small business tools on the Small Business and Self-Employed Center webpage. Or if you are just starting a business, a good place to begin is the Starting a Business page on irs.gov. Some of the tools and resources available to you are listed here. They are designed to help you learn more about business taxes on your own time and at your own pace. We'll go over some of the more popular ones now. First, the tax calendar allows you to view tax payment and other due dates and actions for each month. You can see all events or filter them by monthly depositor, semi-weekly depositor, excise, or general event types. You can even have these calendar reminders sent directly to your email box or automatically update to your computer desktop. In addition, the Small Business Self-Employed Tax Center on irs.gov is a one-stop taxpayer resource. There you will find information on taxes, record keeping, accounting practices, completing federal business and employment tax returns, and meeting other federal tax obligations. IRS also offers 30 electronic news subscriptions delivering federal tax news and information directly to your email box. E-News for small businesses provides important incoming tax dates for SBSE customers, what's new for small businesses on the IRS website, reminders and tips to assist small business self-employed with tax compliance, IRS news releases and special IRS announcements that pertain to SBSE customers, and tax-related information from other federal agencies. The IRS uses social media tools to share the latest information on tax changes, initiatives, products, and services. If you have a smartphone, you can download the free IRS To Go app by visiting the iTunes App Store for an Apple device, or for Android users, go to the Google Play Store. Tune in to the IRS YouTube channels. You can watch short, informative videos in English, American Sign Language, and Spanish. IRS is on Twitter. Our tweets include various tax-related announcements, news for tax professionals, and hiring initiatives. We also have the IRS Tumblr blog, which provides current tax information. And we have a special IRS Return Prepare Facebook page, which posts useful information for tax professionals. audio files for podcasts, subscribe to IRS Podcast on iTunes or download them from the Multimedia Center on irs.gov. We have hundreds of videos and webinars geared toward businesses, individuals, and tax preparers on our video portal at irsvideos.gov. One particularly relevant one is called Business Taxes for the Self-Employed, the Basics. It contains information about reporting profit or loss from a business, self-employment and estimated tax payments, deducting business expenses, and proper record keeping. It is archived under our webinar section at irsvideos.gov. Finally, one special video product specifically geared toward the small business owner is our online Business Taxes, a Virtual Workshop. This product includes lessons on federal taxes and your new business, Schedule C and other business taxes and tax forms, retirement plans for yourself and your employees, federal taxes when hiring employees or contractors, managing payroll and withholding the correct amount from employees, and more. Take a look at this helpful resource. It's interactive and informative. This concludes the video portion of the webinar. Thank you for participating. I hope you found this presentation and the resources helpful. Good luck with your businesses. Now, if you would like to submit a question, select the Ask a Question link under the PowerPoint window and click the Submit button. A subject matter expert is now standing by and ready to answer your questions. Thank you for your time, and we look forward to your questions.
Hi, I'm Sherry Saucerman with the Internal Revenue Service, and we hope you found today's webinar helpful and informative. We're very fortunate to have Senior Stakeholder Liaison Steve Ingram with us here today to answer some of your questions. Welcome, Steve.
Hi, Sherry. I'm very happy to be here today. It was a great program, and quite a few questions came in during the course of the presentation.
Okay, then let's find out what those important questions are that we've received. Okay, Steve, our first question, we did talk quite a bit about record keeping, and one of the questions we got is whether the record keeping can be digital, or does it have to be a hard copy?
The record-keeping requirements remain virtually the same by definition, and now today, particularly with electronic versions of record-keeping products, that IRS does accept digital record-keeping. One example of such would be QuickBooks. I know that we have been trained, a lot of the IRS examiners have been trained on the product so that when they go out and do field audits and so forth, they'll be right on the same page with some of the business owners that are using that product. But digital or hard copy is acceptable. The format and the information must remain the same, however.
Okay, that's good to know. And the information does have to be easily retrieved if we need to get a copy of it, correct?
Yeah, I was just going to add that at any time if the IRS requests access to your records, that you must have them ready and available to go on demand.
Okay, excellent. Thank you. Now, we have another question. We talked about the various types of business structures. So what is the difference between a partnership and an S Corp for taxes and for the partners and for the shareholders for the S Corporation?
Well, both the partnership and the S Corp are flow-through entities, meaning they are taxed through the structure to the partner or the shareholder. For example, for an S Corporation, they would be filing a Form 1120-S, and then a Schedule K-1 would go out to the shareholders. Those shareholders then would report the information from the Schedule K-1, which includes income deductions and so forth, on their own Schedule E for Form 1040. At the same time, a Form 1065 is filed by the partnership. The partnership return itself is called an information return, The 1120S is slightly different than the information return because it captures a little bit more information on the corporate structure itself. The partnership would also issue a Form K-1 that the partner would then use when completing their Schedule E for their Form 1040. So in most respects, they are similar with relationship to the K-1 being sent to the partner or the shareholder of the S Corp.
Okay, so in both instances, the taxes flow through to partners and shareholders depending on the structure.
That's correct.
Okay, and now we have a two-part question here. As a sole proprietorship who sells their product via the web, they ship to U.S. locations only. First of all, they want to know what they need to keep track of to report on their tax return. And then secondly, they want to know if they have to report quarterly or do they just need to report once with their personal tax return.
Okay, and this is something that is becoming more predominant now in our age of electronic commerce. First of all, with regard to keeping track of what you're doing, anytime you're shipping out products, it would be suggested that you track all of those products. I'm sure your customers would like you to do that as well. And that tracking mechanism will be a record of sorts, as well as your own log of sales, destination charges, and so forth. And as far as you mentioned quarterly, if you're a sole proprietor, quarterly does come into play with regard to your income and your estimated taxes. It's a pay-as-you-go system. Let's say, for example, the first quarter of the year, you had no income, you would not have a requirement to pay the estimated taxes for that quarter. Second quarter comes along, you start producing income, then there's a requirement to pay your estimated taxes quarterly. As far as the records that's going to appear on your Schedule C, that is done annually. Now, you can take a look at your records quarterly to compare and make sure you're up to date with everything, but there's no requirement for that information to be sent to IRS. The only, for a sole proprietor, the only issue with anything quarterly would be payment of your estimated tax payments, self-employment taxes, and Medicare. So for purposes of record keeping, the log that you're keeping on tracking the merchandise going out to your customers, that's what you're going to put on your annual tax return, which will be for your situation of Schedule C.
Okay, good to know, good to know. And with the estimated taxes, would you usually have to estimate them based on the income that you've earned for that quarter, or do you do it on a prior year basis? Because as you said, the income will go up and will go back down, and it's hard to estimate how that's going to be in the future. You
can base current year estimated taxes by paying 100% of the prior year estimated taxes to get out of a penalty situation. So that's the key of looking backwards, let's say, not knowing what it's going to be. But if you're doing a pay-as-you-go, you earn the income, you pay the estimated taxes on that income as you earn it, and then you won't ever fall behind, and you'll be right up to date with your payments. So as I referred to before, income received, estimated taxes paid. That's less your expenses, of course. You'll have to determine that as well.
Okay, good. So you've got last year's to base it on. That's your minimum, and then you can take what you're making this year to make a determination as to whether you need to make a higher estimated tax payment.
To avoid penalty, yes.
Thank you. Okay, now going back to the business structures, can you review the pros and cons of an S Corp versus an LLC?
Okay, I hit on S Corps a little bit earlier. LLCs are state-regulated entities. The IRS does not have anything to do with the regulation of LLCs in a particular state, and many states are different in how they treat them. For purposes of federal taxation, LLCs are going to be taxed either as a partnership, a corporation, or what's referred to as a disengaged entity, which really results in a sole proprietorship. So you could be a single-member LLC, which in essence would be a sole proprietorship. An S Corp An LLC could take on the structure of an S Corp, or it could take on the structure of a corporation. As I said previously, the LLCs are regulated by the state, so you'll have to check with each individual state to find out how your state would treat the LLC. But for federal taxation purposes, you could be an S Corp and an LLC at the same time. You could be a C Corp and an LLC at the same time, or you could be a sole proprietorship and an LLC at the same time. Being called an LLC, but filing taxes as one of these three entities for federal tax purposes.
Okay, so LLC is nothing, it has no relationship to the taxation. What's the taxation would be an S corporation, a partnership, a C corporation, or an S corporation, correct?
That's correct. That is correct. And if you go to the IRS website, we have a page dedicated to LLCs. And it clears up some of the confusion that folks are having over the differentiation between a state-regulated entity and how it's taxed at the federal level.
Okay, and that kind of leads us into this other question, because we are getting a lot of questions about the different business structures. They were wanting to know whether it was possible to talk about instances where it would be good to choose one structure over another. Does it depend on income thresholds, liability considerations? Is that really something that is a tax issue?
Well, it is. You really would have to look at how complex you want your business structure to be. By far, sole proprietorship is the easiest way if you're just an individual. Once you start getting more people involved, then you have to look at different business structures, partnership versus S Corp. You know, you'd have to look at how you want the information to be retained, what type of expenses and deductions you have. A C Corp is by far the most complex of any of the business structures and involves much more by way of computation and double taxation in some respects. The C Corp is taxed, and then the shareholders are also taxed by way of dividends. Structures of the S Corp, you can't have any more than 100 shareholders for an S Corp. You can have unlimited numbers. You can also have estates and trusts involved in C Corps and so forth. Partnerships, again, are for more than one person, but again, they are a flow-through entity, and everything comes back to the partners by way of K-1 and expressing the income or deductions related to the partnership. So you really have to look at the complexity of what you're doing, of what you want to do, let's say. I mean, you could always start out as a sole proprietorship, maybe change to a partnership, or go on to a corporation later on. There's no restriction on doing that annually. I mean, you can change it as you see fit. It just depends on the size of your company, how big it is, and how many players are involved, and the kind of shareholders you have.
Okay. Let's change gears here a little bit. Our next question deals with expenses. So if you travel almost daily to a certain location for business purposes, is it okay just to log the days that you made this 3-mile trip, and then at the end of the year multiply the number of your trips by the 3 miles, as opposed to actually logging your beginning and ending mileage each and every time?
Well, for record-keeping purposes, you should document the dates and times of these trips. If they are consistently done to the same location, and let's say you're doing it 3 days a week, you can combine those, the number of miles each day, specifying the dates and the time you were there, and add those up at the end. There's not a problem doing that, as opposed to doing your mileage log each and every day. Now, you'd have to be able to show that, let's say in a given month you were there 9 days, and this is the same location you went to, it's the same number of miles. Tuesday, Wednesday, Thursday, I was there at this location, same number of miles, that equates to 90 miles. That would be fine.
Okay, thanks. Now, can you confirm, is a business required to claim all of its expenses?
Well, I don't know why they wouldn't want to, because it's reducing the income that's taxed on it. But yes, you should be recording all of your expenses in connection with earning that income, yes.
Especially if it relates to being able to claim a credit, I believe is where it really comes into play.
That's right. There are many general business credits out there that are available, but you would want to be able to itemize your expenses in relation to whatever credit you're applying for.
Okay. Now, how can I tell the difference between an employee and an independent contractor?
Well, that's a common question that we hear across the board, and it seems to come up all the time. And there is no one blanket rule. Each relationship has to be looked at separately, and there are facts that provide evidence, and it really deals with the degree of control that the payer has over the payee, and how much control and how they're paying them. So, for example, there are 3 factors that are included. Behavioral control. Does the company have control or the right to control what the worker does, how they will do it, when they will do it? Do they provide equipment? The second one is financial. How much of what this payee or worker is controlled by the individual? Are they paying them by the hour? Are they paying them by the job? Are they offering a pension plan, a vacation plan, some type of health insurance, these types of things? Relationship is also another one. You know, what type of relationship do you have? And I can give you an example. Let's say you have a plumbing job, and you hire a plumber. You give him the blueprints. You say that I would like this building plumbed with this type of pipe here, this type of pipe there. It needs to be completed in 2 weeks. The guy comes and goes when he pleases. He provides his own tools and equipment to get the job done. On the other hand, let's say you hire a plumber. He comes in to do the same job. You give him the blueprints. You say, here's the pipe. All the piping is over there. All the connectors are there. There's the tools over there that you're going to use. I'd like you to report in the morning at 8 o'clock, maybe take lunch at 12, finish the day at 5. I'd like you to be here Monday through Friday. There's some safety equipment I'm going to provide for you. You know, these types of things all come into play. Now, in those 2 scenarios, scenario number 1 leans towards independent contractor. Scenario number 2 leans towards employee, because the amount of control over the relationship, how he's being paid, the amount of equipment that you're offering him, telling him when to be there, how you want it done, when you want it done. Now, if there's still confusion after the fact, which happens in some cases, there is a Form SS-8 that can be filed to allow IRS to take a look at, and there are several questions on that. Either the payee or the payer can file that Form SS-8. That will determine, or allow us to determine, if the payee will be treated as an employee or an independent contractor. And there is some relief provisions for a situation, let's say, where a payee or a worker was misclassified. And I don't want to get into all that, but that is also on the IRS website under independent contractor versus employee, if there's any confusion or any questions about the relationship.
And I do believe we have a archived webinar on our IRS videos page that is specifically for independent contractor versus employee. So that's good information. So looking at the independent contractor issue, if I pay a contractor to do work for me in the course of my trade or business on 2 separate occasions, they came on 2 separate occasions. The first time they paid them $500, and the second time they paid them $400. Each time they were under $600, which is the reporting threshold for 1099 miscellaneouses. So since they were under $600 each time, would I need to file a Form 1099 miscellaneous?
In that situation, you would be. You could pay a person $200 on 4 separate occasions during the course of the year, but because you're paying them an aggregate total for the annual period of over $600, a 1099 miscellaneous would be required. So that's going to be for any amounts paid that total $600 or more for the year.
Okay, great. So now if a taxpayer, they have a business, sort of a business, but they're not making any profit for several years, so it's probably a hobby. And they receive 1099 miscellaneous. How do they report that to the IRS so that they they're reporting the income, but they're able to deduct their expenses to show that they had no gain.
Well, again, you have to take a close look at hobby, versus business. The fact that they're receiving 1099 miscellaneous forms is going to alert us to the fact that we're going to be looking for that to be reconciled somewhere. And what will happen then is we'll be sending out, if we don't get anything to identify that, we'll be sending out some letters saying, hey, shows you received this income and we couldn't find it anywhere. For that scenario, and again, we have to look closer at, was there an actual intent to make a profit? They're being paid by 1099 miscellaneous, so the dollar amounts seem to be a little bit larger. Schedule C is a situation where you would file to reconcile the 1099 miscellaneous and then just match your expenses up against it. Now, I believe they said that there was no profit involved and they don't want to take a loss. Well, they would maximize their expenses to the amount of the income if they had those expenses. But again, you have to go back and take a closer look over let's say a 5-year period to see if you can really be determined a hobby or a business.
Okay, so whether it is considered a hobby or considered a business for profit, the income would still be reported on the Schedule C, and they would just write their expenses on there the same way for both. The difference being, if it really is a hobby, they would not be able to take a loss against other income, correct?
That's correct.
Oh, excellent. Now, we talked a little bit about the 1099s that you'd issue for independent contractor. We have a question here. They're wondering, what are the payroll taxes that an employer has to pay and the taxes that the employee has to pay?
Well, for an employer-employee relationship, the taxes that must be paid are, federal income tax. You would indicate how much of that you want withheld by way of a W-4 with your employer. Social Security and Medicare taxes. The employer would pay their share of the Social Security tax and Medicare tax, and the employee would also pay their share. Those are the only taxes that are going to be involved for an employer-employee relationship.
Okay. Well, thanks. That's about all the time we have for questions today. I want to thank all of you for watching our webinar. We hope you learned a few things about starting and operating a business and what records you need to keep. But before we close today's broadcast, Steve, what are the most important points that you want the attendees to remember?
Well, we've heard it several times today, and record keeping is the key to everything. I can't stress it enough. If you have good records, you'll be fine with your business. You'll be able to answer any questions anyone has for you about your business, including IRS. So that is the key. So Publication 583 has a lot of good information on record keeping. In addition, there are a lot of available free resources on IRS.gov. The Small Business Self-Employed Tax Center would be a very good start. It encompasses everything that a small business or self-employed individual would come across during the course of running their business. And in fact, a lot of the information you heard here today was derived from that same tax center. We also have the online tax calendar. Will help those of you that have deposits required for your business and have employees. The tax calendar will identify important dates during the course of the month. And each month it will populate those dates with information about your tax deposits as you see fit. And you can also enter much more information on the online tax calendar. You can download it to your own personal computer. Another thing I do want to mention is the subscription to e-news for small businesses. I think it was mentioned, of course, during the course of the presentation today, that will keep you up to date on any changes of their policy, forms, publications, anything that has to do with small business. You'll get the information the exact same time that we get the information here working at the IRS, that anything that deals with small businesses. And then the last thing, if you don't want to deal with the taxes yourself, you can use our directory, our tax return preparer directory on IRS.gov. Simply go in there and put your zip code in, and you can order up tax preparers within 5, 10, 25, or 50 miles away from your location. You'll see that populated with everyone from CPAs and to enrolled agents and tax preparers, what their credentials are and their information is all there.
Okay, thanks so much, Steve. If you all have any questions that were not answered today, please visit the IRS website at www.irs.gov using the keywords small business, and you'll find links to the pages that we shared with you today and a lot more information. Please join us tomorrow when our webinar topic will be Staying Afloat, Planning for Emergencies Before They Happen, and then again on Thursday for tip reporting and tips versus service charges. For our Spanish speakers, we have a special webinar for you on Wednesday on worker classification. Clasificación del trabajador, empleado o contratista independiente. It's not too late to sign up for these webinars. Just go to irs.gov, use the search term webinars, and click on the link for webinars for small businesses. In case you'd like to review this information again or refer someone who is not available to view one of our webinars, all of these webinars will be posted by the end of May in the IRS video portal at www.irsvideos.gov. For tax professionals who joined us today and were wondering about earnings credit, certificates of completion are not being offered for this broadcast. But we do hope you found this information valuable and found some great resources for your small business clients. As you exit today's webinar, you should get a pop-up box with a survey regarding the presentation, or you can click on the link for the survey. In case you don't receive the survey, you may need to disable your pop-up blocker. Please take a few minutes to complete our survey, including the new comment feature. We'd like to hear what topics are important to you, and while participation in the survey is optional, your feedback helps us in developing future webinars. Thanks again for your time and attendance. Much success to you in your business and practice, and we hope you have a great day. Thanks.